Welcome back, folks. This is Darkmaster bringing you the latest insights from the trading world. Following our recent video on support and resistance levels, today we're diving even deeper into this topic to equip you with more valuable knowledge. We've picked another essential concept for traders: Fibonacci levels. What are they and how can you use them effectively? Let's break it down in this video. Alright friends, let's get started. So, what exactly is the Fibonacci sequence? It's one of the oldest mathematical tools originally used in ancient India for composing poetry. The sequence gained prominence thanks to a 12th century European mathematician named Leonardo, who went by the nickname Fibonacci. The sequence is an infinite series of numbers where each number is the sum of the two preceding ones. 0, 1, 1, 2, 3, 5, 8, 13, 21, and so on. The relationships between these numbers lead to what's known as the golden ratio, which astonishingly appears not only in nature and art but also in trading markets. Based on this sequence, Fibonacci levels were developed to help analyze and predict asset price movements. These levels assist traders in identifying potential correction targets and strong support or resistance zones. However, it's important to know that Fibonacci levels aren't a magic key tool. Markets are dynamic and trends eventually reverse or correct. Therefore, using Fibonacci levels with other analytical tools is best, but more on that later. Now let's move to the charts. We'll examine the Bitcoin USD chart as usual. To identify the Fibonacci levels, we draw the retracement from the lowest point to the highest point of this movement. These levels correspond to specific percentages derived from the Fibonacci sequence and are commonly set at 23.6, 38.2, 50, 61.8, 78.6, and 100%. Applying these levels to your chart involves selecting two key points: the price movement's peak and trough. From these, you can gauge potential correction depth and set informed targets. The beauty of Fibonacci levels is their versatility. They can be applied to various instruments such as cryptocurrencies, metals, stock, and more. Besides predicting correction points, they also help anticipate potential trend continuations. So, what advantages do Fibonacci levels offer you? They allow for more precise identification of support and resistance zones using our discussed percentages. When the price approaches one of these levels, a trend reversal within that range is likely. This precision helps you pinpoint optimal entry and exit points on the chart. Additionally, you can use these levels to set your stop loss and take profit orders strategically. For instance, if you're going long based on a Fibonacci level, placing a stop loss just below that level can safeguard you against significant price drops. Remember though that Fibonacci levels are most effective alongside other indicators. Consider incorporating tools like moving averages, RSI, and MACD to deepen your analysis. Check out our other videos for more insights on these indicators. Let's sum it all up. Key takeaways. Fibonacci levels aid in forecasting corrections and identifying crucial support and resistance zones. Primary levels include 23.6, 38.2, 50, 61.8, 78.6%. Best used with other technical indicators for a comprehensive analysis. Applicability. Effective across all types of financial instruments. I hope you find this video helpful. Be sure to check out our channel for more great content about cryptocurrency. Thanks for being with us, friends.